Welcome to FT Markets. Over the past year, 4 European central banks have taken the unprecedented step of imposing negative policy rates. That means, in effect, banks are charged when they want to park their surplus cash there. Some analysts now say that ordinary bank depositors are next in the firing line. With me to discuss this phenomenon is Ferdinando Giugliano, the FT's economics correspondent. Ferdy, if we go to our first graph, we can see the 4 banks right here. Why on earth have they decided to go below zero?
Well, I think, in a way, the ECB is central in all of this. When the ECB decided to move its deposit rate to minus 0.2%, these other banks in neighboring small open economy feared that cash would all of a sudden flow into their country, leading to an appreciation of their exchange rate. So they really felt they had to slash their own rates in order to dissuade investors from buying up their currency, moving their money there. And so we have Switzerland and Denmark, for example, going as low as 0.75%, negative 0.75%.
And so this is to stop their own currencies appreciating, thereby making potentially their exports, for example, less competitive.
Well, it's for Switzerland, for example, there is a real story about the fear of the franc appreciating too much. That's Switzerland doesn't want its exporters to be damaged as much as they could otherwise. But in some cases, like in Denmark, is really the central pillar of monetary policy is keeping the peg between the Danish krona and the euro. It's a fixed exchange rate, which Denmark has successfully kept for quite some time. And so their credibility really hinges on ensuring that these inflows are stopped.
And if we see our second graph, we can see a related but yet different phenomenon, which is the negative yielding bond. And we see really from June last year, when the ECB imposed its negative deposit rate, the number of negative yielding bonds rocketed, reached a high of 3.5 trillion. That's come down after the sell-off in bonds recently, hasn't it? But still, there's 1.5 trillion negative yielding bonds out there.
Well, it's a very fascinating conundrum, if you want. People are essentially paying for the privilege of keeping their cash with some government. So governments are borrowing at negative rates. Now, this seems puzzling, but when you think about the fact that the money which banks do not want to park with central banks anymore, needs to go somewhere, then that somewhere is government bonds in part. Then obviously there is some sort of, there are speculative reasons as well. If you believe that bond yields will continue falling, then you might as well buy now because you think you'll be able to sell them at a higher price later. So that justifies really even the small hit which you may take on paper initially. But now, over the last few weeks, we've seen that trend stopping. Maybe investors have realized that this has gone too far. And so as we see, the number of bonds with negative yields has fallen quite sharply. However, there's still a lot of uncertainty over what direction bond yields will go to in the next few weeks.
And if we see our final graph, we can see that inflation is slightly ticking up in the Eurozone, albeit from a very, very low level. I guess 2 questions really. Given that inflation expectations are now slightly better than what they were only a few months ago, are the negative deposit rates going to change anytime soon? And if not, will depositors feel the hit? Will they also be charged to park their cash in banks?
Well, your second point is definitely the interesting part, very interesting part of the story, or the very worrying part of the story, if you want. How low can banks go without passing on these rates onto retail depositors? Some institutional investors have already been whacked, for example, in Switzerland. Now, I think in a way there are some reassuring messages coming from inflation, and that's because of the purple line. Partly the price of oil, which has fallen dramatically since June of last year. We start seeing it picking up. At the same time, all these measures central bank measures seem to be having an effect on inflation expectation. And it looks like inflation is slowly starting to go up. Now, we know the ECB has said it will not slash its deposit rate further than minus 0.2%, but other central banks could in theory. However, if inflation continues to rise, that means that we will not get there. However, for example, other countries, Switzerland or Sweden in particular, are seeing their inflation rate still very low and falling. In Switzerland, it's minus 1.1%. There, we could see perhaps the central banks forced to do more. And the consequences for banks and retail savers are very harder to predict.
Thank you, Ferdinando. So retail depositors unlikely just yet to feel the chill from banks simply for parking their cash there. But as central bankers plunge further into sub-zero rates and into the great unknown, anything could yet happen.